Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Good afternoon, everyone. It's Tuesday, May 23rd, episode 34.
34.
Right? I'm Andy.
Eric Susie.
Yeah, welcome.
Vantage Point with True North Wealth Partners.
That's right.
Another episode.
Yeah, that's right.
Time goes by when you're having fun. It's May. How's your golf game?
Yeah, horrible.
Come on. You had good fun. I thought you played well. Huh?
No, I was coming. I had COVID, right? So,
I guess you did.
So I came off
I totally
COVID.
forgot about that. Yeah.
I was laying on my basement floor, drowning in sweat.
Right, yeah. God, yeah.
But it was Easter weekend, I think, is when that was. But I haven't. Yeah, it's bad. Yeah. That's all right. I don't care anymore.
Yeah. It's all right. It's all good. Moving on, right?
Yes, sir. So crazy. What's going on? Kind of. We got what's in the news, right? Debt ceiling.
Yeah. There's still
the drama,
hacking at it back and forth. That's to be expected. So a lot of headwinds. Still, market climbing the wall of worry. It's going to be like that between now and the end of the year. So still not out of the woods. There'll be green sprouts here and there, but the overall activity is still going to be challenging for the markets and the economy in general.
Yeah, for sure. Yeah, debt ceiling, they'll figure it out. They always come down to the last minute.
Right.
I mean, they won't default.
Yeah, but they're going to.
I mean, even if it was delayed, even if they said, even if like a month late, that's not a default.
No, it's
6
good.
months late. They're not going to just not make the payment.
Right.
And,
it's just it's storylines to get eyeballs to watch the TV networks.
Yeah, the dramas.
The drama.
Yeah, and I was looking at a chart like this amazing, the trend line and the trend line for revenue, tax inflow, right, is, it's trend, I mean, the inflow is well above the trend line. Right. So it's like they're playing money. It's just spending too much.
Spending too much, right? How they're dolling it out.
Someday we'll figure it out.
Another billion to wherever it's going, Ukraine, here and there. Oh, easy money. Slice it around.
Yeah.
All right. Well, let's talk briefly just on some anything, box office, anything jumping out on the trackers.
I'm not. Everything actually. Unemployment's pretty low still, right? So if we head into a recession, that could be a bright spot, right? Because when they get the furnace going again. Yeah. I mean, everything's. Yeah. Looking pretty good, actually. People are returning to movies. Mm-hmm. Hotel, occupancy is down a little bit, but not too much.
All right. GDP, as far as GDP, I know different people are all over the place, but sort of the old news and how they calculate it. So the GDP nowcast from the Federal Reserve Bank of Atlanta just came out, 517. That's the latest. The next one will be 526 as far as the update, but they're showing 2.9% GDP growth rate for the second quarter of this year versus HEDGI is not that. It's negative, over 2% negative. So we'll see who's right at the end of the quarter. But last quarter, the day before first quarter ended, Federal Reserve Bank came in and they cut it basically in half and it got down to 1.1. So GDP first quarter came in at 1.1, which is closer to where the HEDGI folks were at. But anyways, so we'll see how it all shakes out. But the overall trend is GDP slowing is the overall trend. Corporate earnings are slowing. Things of that nature. Retail this week, everything's slowing in retail. Lowe's, Home Depot, everyone's forecast slashing, no one's spending. No more projects per se around the house. It's necessities over everything else. So you hear that in Walmart as well. So
now, though, I just get our family credit card bill, and I will say that the consumer is very strong. Consumers
about that.
are still spending.
They are, and we're at. I was on the call this morning with that. I'm trying to remember it now. So actually, where did I put that? Here it is. I knew I had it. Okay. Yes. So good point. Thank you for bringing that up. So consumer, credit card balance, all-time high, up 17%. So credit card balance, all-time high, up 17% year over year. Credit card interest rate, all-time high at over 21% is the interest rate now on credit cards.
Yeah, so if you carry a balance.
Balance, yeah, which most folks do now, unfortunately. But then BKO bankruptcy rates 6%. That's the highest since 2008. So that's just on the consumer. So yes, they're still spending, but the fat lady is going to sing here soon, and it's going to be like I talked about retail slowing. NASDAQ, so the outlier there, and there's a chart on this, but again, Meta, Alphabet, and the 5-6 stocks are holding up the NASDAQ primarily. So versus the index itself, that's what's that it's helping the NASDAQ QQQ index and making it look good, up being over 19% now or what have you year to date. That's not indicative of the overall markets. And again, small cap stocks are just let's call it flat. Dow's pretty much flat.
Mid cap's down.
Yeah. So you have to look at the whole picture and all that. In regards to the banking and the failure in Silicon and all the other banks, and then again, it's not over. Even Yellen, which I'm getting tired of her, but anyway, she came out saying, there's going to be more consolidation coming, more failures are coming. So this is just Unleash Prosperity, put this out, but it's just a nice little summary over the history. So FDIC, this is insurance of the coverage for deposits. So what is insured by FDIC? So back in 1934, so folks had $2,500 is covered, backstopped by the government. And you can see then it went to $5,000 in 1935. 1950, it jumped to $10,000. 1966, it went to $15,000. 1969, jumped to $20,000, the year I was born. 74 went to $40,000. 80 went to $100,000 finally, went to times. And then stayed there 1980 until 2008. It was $100,000 from 1980 to 2008. And finally, in 2008, they increased it to $250,000. I remember that day. $250,000 is the backstop for people being covered by FDIC.
Yeah.
And now the talk is to infinity and back, so unlimited, so cover everybody. So that's not a good thing, folks. So I'm joking with that. But
if I have. Is that per account or per person?
Yeah, great question. It's per account. So that's why they go to different banks. Hey, I want to have 250 at this bank, and I have another 250 at a different bank. Now, if it's joint account, husband wife, it's 250, it's 500. So you're covered there. But yes, that's a very good point. 250 per account, per bank, unless it's joint.
The joint doesn't matter if it's husband wife or
just if it's joint.
Yeah. Okay. All right, good to know.
Yeah, no, that's good. Moving on to
real estate, right?
Real estate. Oh my Lord! So I check in with my brother, so I ask him what's the pipeline. So firm not to be announced, but the point is, in the good old days, it was 1,200 appraisals in the queue. They call it in the pipeline a day nationwide. So I asked him 180 basically.
There's more new mortgages?
Appraisal. So it's coming from houses, either refinancing or new mortgages or whatever. It's just people activity in the housing. That's 180 in the queue versus we're in springtime.
Yeah.
And you should have a couple, over 1,000. This is nationwide. This is 180 nationwide for a big firm, big bank in the country. And people are rate locked. And I finally brought this in. I talked to you about this. So this is just a publication we get monthly from the lady in my neighborhood, neck of the woods. So springtime, typically you have a dozen houses easily. There's like over 1,000 houses in the neighborhood where I live. There's only 2 active listings. So it's crazy. Again, being rate locked.
Yeah.
30-year fixed rates. We're not going anywhere either. So 30-year fixed rates, 6.95. And with the Fed, I know they're going to be meeting here in June. People don't like to see it. I've told you this. I'll be on the camp that they're going to raise rates. I hope I'm wrong. They need to pause. But the point is, there's probably one more rate increase, whether they pause in June and then do it later or just pause for the rest of the year. But I can see one more out there just because the PCE, personal consumption expenditure, that's coming out tomorrow. That's still going to be hot. They want that at 2%. It's going to be elevated around 4%. So, and that's Fed's number one thing is tame inflation. And, their old way of looking at things, it's raise rates, raise rates, raise rates. So you heard it here, there's, 3/4 of the people don't anticipate a rate increase. I'll be the minority and take it. There could be.
Yeah. So I think they got raised their target.
Yeah. Right.
And just get used to it.
Right. That's exactly right. So yeah, that's the new way of doing things. Yeah. So before we get into all the charts, anything else before we get into tips of the month too?
Yeah, I think, just, we're kind of going back to the banks and cash and, something like I've been telling.
What are you seeing?
So I've been telling my clients we've been using a lot of the money market, swap money market, right? So, which is not FDIC insured. Right. That's, it's a money market. So technically it's investment.
It's investment, right.
But it's dollar for dollar, and it's done well. It's got how many billions of dollars in it. I look at the daily liquidity of it, and it's done well. It's holding its own. So, but there's going to come a time when we're going to ease out of that. And so, what's a strategy for that? Mm-hmm. With bonds. Yep. Last year, worst bond market ever. So now bonds are looking better. Like bond fund, have you ever seen, bond fund managers? I mean, no offense to bond fund managers, but if you go to a party and there's a bond fund manager, he's in the corner talking to himself.
Yeah. So, I used to work in the fixed income at T. So I know bond fund managers. So yes.
So now, like when you talk to bond fund managers, they're at, their blood pressure goes up. I mean, they're excited about the environment. So, so as you look at easing out of a money market, going to like a bank loan or a short duration, something that is paying a decent yield, 4 to 6%, and you get some market appreciation.
Market appreciation.
So that's eventually where we want to get back to having more of a kind of a solid bond portfolio. Yep. So it's looking better and better. It's just still being patient.
Yeah. Oh yeah, patient. Yeah. There's still alts out there and other things, treasuries. There's a whole bunch of I bonds. There's a lot of stuff people can do and use.
Yep.
But, anything else on that?
Last month was Social Security Awareness Month.
Oh, all right.
Did you know there was such a thing?
Yeah. Everything. They're labeling everything. Yeah. Yeah, I hear you.
There's a month for everything, I
Correct.
think. So, but anyhow, just a little bit of tidbit on that. Do you know who Ida? Do you know who Ida May?
Ida May. No, I do not.
You know that name? She was the first recipient of a Social Security check benefit.
There you go, Ida. All right.
Yeah, it was back in, let's see, what's the day if I can read this? January 1940 was the first Social Security check. It was $22.54.
All right.
Yep. And Ida lived to get this. So the first recipient, she lived to be 100.
Oh my God.
So
back then?
Wow. So she put it to him.
Yes, she did. She took advantage. She was on the good side of that one. Yeah. Wow. Good.
Yeah.
Wow,
she got more. So she got more definitely than she paid in. But anyhow, to put it in perspective too, kind of then and now. So back in 1935, average life expectancy under 60.
All right.
We'd be on our deathbeds.
Yep.
So today, the average life expectancy is between 78 and 80. Back then, most people didn't even live to collect their Social Security benefit. Mm-hmm. Now, it's a part of a lot of people's retirement plans.
Yes.
It was designed to be a supplemental retirement. Now, 40% of retirees live solely on Social Security.
Yeah, it's too high of a number, unfortunately.
Yep. And so the workers. So get this. So the worker to retiree ratio back then was 160 workers to every retiree. Okay. Today it's 3 to 1.
There you go.
3 workers to every retiree, right? So.
And which direction is it going in the future?
Yeah, it'd be 2 to 1.
2 to 1. And it's going lower.
Yeah. So anyhow, just some interesting tidbits.
Hence why they need to adjust things at some point in time, so it doesn't trust fund doesn't run out.
There's
cut.
There's a lot of debating around that.
Right.
There's different solutions potentially. So
it can be done, and it will get cured at some point. It's just who has the gumption to take that ball and run with it.
Yeah. So anyhow, happy Social Security month last month,
right, folks. Hopefully, now the COLA won't be as great as last time. Remember, the COLA was extremely high. So this upcoming, because things are going down now. So
that's right.
Still should be a couple percent, but we'll see when we get close to October. They'll come out with a new number. Tips of the month in regards to I-bonds, because you and I have talked about that in the past, and your clients have utilized that. We've suggested using that.
Yep.
So this is coming from FA Magazine back on May 1st, but I-bond rates dropped to 4.3%. Okay, it was over 9, then 6, now 4, but still 4.3% is a good way to lock it in. And
Sure.
Just want to push that out as far as what the new rate is. Again, 4.3% for the new I-bond series. All righty. Well, you ready to get into some charts? And for those who are interested,
I thought you'd never ask.
Strap in. So
where's my pillow?
There's a lot there. I'm sorry about that, but I do hear a lot of good feedback. People do like to see the visuals with it. You can stop it, replay it, and listen to it. So I'll try to go through as fast as I can, but not too fast. But all right, folks. Again, still market volatility is coming. So don't take this law. You see the VIX again. It's just a VIX. Oh, and then the VIX on that. I don't have that sheet. So quadruple witching was last Friday, and that's a
again. I was triple witched. I think once in high school.
Triple witch, yeah.
Or triple witch. Oh, yeah.
All right. So Friday was that, and the rate of billions is 3.8 billion trades. It was the lowest I've seen in over a couple of years. So, and what's affecting the volatility now is a 0 days, 0 DTE, 0 days of option expiration. And now they have a 1 day. The VIX 1D is a symbol for that. But my point is, so it's interesting how it's taking away from the 30-day, and you get more volatility in the near-term day-to-day stuff. So that's going to be changing how this dynamics works. But you'll see this VIX pop up. Again, right now, 17.2. It's been in the 16, in the low area. We do still anticipate it going higher over the next 30 days. The VIX average is 18.7. So that's just the volatility. Pullbacks, again, we've only had one technical 5% pullback so far. You'll see that going higher compared to 12 last year. And that's just a pullback in the S&P earnings. S&P earnings, again, they're coming down. You can see here going straight down. Historical average 7.8, earnings is 0.5. So they're going to be going negative. Earnings, they were negative for first quarter somewhat. They are going negative for the second quarter. So this will go under the zero line as this gets produced out into the next few months. So that's all part of the overall slowness of the economy. Still pockets of green shoots, but you still have a lot of headwinds too. The 210 yield inversion, so you can just sort of see it's negative 0.57. It was 1%, so it's come off the negative 1%. But still, it's inverted. It's been that way for well over a year now. And typically, when you have it this long, you are in a recession or going into one. Mortgage rates, we talked about that. This is as of May 18th, but the 30-year fixed is 6.4. Right now, it's 6.95, and it's just a new normal. So it's going to be, the average since 1990 is around 6. Yeah. So we're going to be hovering around that, the average there for a while. Housing starts. We talked about housing. The housing starts. New units were up. Now, existing home, people are, again, rate locked. They're not really selling. So that's why the builders are forced to start building new housing starts. So that just shows you the dynamics of it all, pretty much near the average. And then, again, single, unfortunately, is going down. But multi, that's all the apartments have been going up steadily. So singles are down, which is not good. Multi is up. That's renting. And part of the whole mantra is, you'll own nothing and be happy. So rent versus owning. So again, you got to watch out for all that. Months of supply of new inventory. So at least it was up again, 11 months or so. Now it's down to 7.6 months of inventory. These are houses on the market. If you remember, we had like 1 or 2 months, 3 months of inventory a couple years back. So at least it's gone up. That's inventory, supply. But again, it's coming back down because, the uncertainty and people don't necessarily want to move unless they have to. The balance sheet, okay, so it was going down. Then we had the influx there. It spiked it up for the banks. So the government backstopped that and then went up, and it's coming back down again. So $8.5 trillion. Now the quantitative tightening is still happening behind the scenes. So the 90 billion, what have you, per month. It's not the full 90 billion, but they are still tightening behind the scenes, which has an effect of like a rate increase. So that's a silent, behind the door. Fed dot plot. Again, the Feds, so you can just sort of see where they're at, 2023, 5.12. So a couple of them want to go higher. Some are just flat. So you got some outliers there. But then eventually it's going to go lower. But still higher for longer and sticky inflation for longer as well. Not the 2%, the PCE that they want to get down to. Economic growth, again, just slowing in general. Historical average is 2.8. You're not going to see a 2.8 print for a while. So it'll be in the 1% print or lower for the next few quarters. Leading economic indicators, again, just negative 8%. So again, when you're negative, you're in a recession. So it's a rolling recession, just hasn't been fully developed yet. Economic activities, things are slowing. Non-manufacturing is 51.9. It did bounce up, but the manufacturing side did, it's still below 50. Anything below 50 is contracting. Payroll gains, again, they want to see that the Fed's trying to damper that down. So it is going downward. That's what they want. So you can see that there. It is going down. Last projection, 253,000. Labor force participation rate, it's great. So 62.6, that's the highest it's been for going back back in the 69, 70 era. So what have you. It's getting back to near all-time highs. The peak was 67, obviously. Historical average 62.8. We're at 62.6 right now. Wage growth. The Fed wants to taper that down too. So, they had to free money, easy money, pay, and then they reverse it. So the historical average is around 3%, 3.3. It's right now, it's coming down. Okay, it's about 4.5. So that's something they're still working on. Consumer spending, we talked about that. Retail, that's going to be going negative here soon. So you'll see that going lower. Non-store retail, that's online shopping, things like my wife does. I'm sure Becky too. Auto sales. I brought this in just to see. A good green sprout is auto sales are going up. Yeah. So that's, truck, auto, so that's trajectorying up. So that's a green shoot, which is good.
Yep.
Consumer price index, CPI, it's coming down. So again, the high point is 9% last year is over with, but still going to be elevated, still going to be right around 3.75 for the rest of the year into next year. So that's the CPI. PCE, again, core, non-core. Again, it's unfortunately.
PC is minus food and shelter.
Yes. Uh-huh.
Yeah.
Well, that's the core, yeah. So the core, this is the Fed's preferred
PCE
rate, the PCE.
The 2%.
It's 2%, yeah. So, but you back out the food, which is the core, it's still a 4.6. That 4.6 needs to get down to 2, and it's going to be elevated and sticky like we've talked about for all year.
Yeah.
I threw this chart in just to show the, distortion of the markets. So this is the S&P 500 tech going back 5 years. So the Meta, Amazon, Apple, Netflix, Alphabet. That's just 5 large cap, FANG stocks you hear about. So the tech's S&P is up 128% over 5 years. The FANG's up 95. The S&P 500 is up 54. But if you equal weight all the companies out within the S&P equally, it's only up 41. That just shows you, okay, it's basically 60%, overweighted those 5 or so companies, which is why we see the NASDAQ doing great so far this year, just because of the handful of companies are holding up the indices in the markets. Stock bull market, bear market cycles. So as you can see, still in the bear camp there. So it's been 1 year, 4 months, and we're still there. So we're grinding it out slowly. But again, the average bear lasts 1 year, 2 months with a decline of 36%. So again, we're past the 1 year, 2 months, but it's just a slow grind. And eventually we'll get through it, but just not yet. Bond market volatility. So it's come off the high, from the COVID. It had a big spike up here last month. Near 200 on the MOVE index. It's the MOVE index is the volatility for the bond market, which is similar to the VIX index, which is volatility to the equity markets for the options. So the MOVE index has come down, but still elevated, 132. The average is 84. So the bond market is still telling you something that we're not out of the woods. Fed rate hikes, you can see our current cycle. Okay, it's the second strongest from the 1980 cycle, which is straight up. But you can sort of see how long these go and develop. And the bank failures, so you can see here, update that. There's now technically 3 that are officially and more to come. But then look at the dollar amount, over 6. Number of banks failures was 3, and then the dollar amount deposits, $350 billion. So you can see that we're affected. A lot more than going back to the 2008, 09 when you add that together. So it just shows you, the top 3 or so banks have a lot more influence.
Well, part of those too, you have the technology.
Yes, that's all
the high dollar.
The SPAC. They're all in California banks too, for the most part. Bank unrealized net investment loss gain. So this is the net unrealized. So mark to market's gone away for these banks when it comes to real estate and holding things. So this is what still has to mature, and basically is outside. There's over $600 billion in securities that are not marked to market yet. So the commercial real estate, that foot is still has to be landed yet. So no one's priced commercial real estate because it hasn't had to be priced. It was free money, easy money for the past 10, 15 years. But now rates are higher. They're getting squeezed, hence the bank's failure, hence all this. It's all part of it. It's all a big song and dance show. So there's a lot there, but hopefully that helps just keep things in perspective. So we're here with you. There's been some rebalancing that has went on last month and other more tweaks here and there. So right now you're set for your portfolios, and we're going to ride this the spring heading into summertime, and then we'll make more tweaks as we deem fit. Please reach out to us. We appreciate you. Enjoy the nice sunshine, and we'll take care. And and also make sure you subscribe and click, and then enjoy our new newsletter feeds too. So we're pushing those out. So that's something new on our website. We have a blog page, and then also the LinkedIn too. So that's just a new service we're doing for our clients to take advantage of all the 20 or so publications for free.
Sure.
You don't have to subscribe to Bloomberg and Wall Street Journal and all that stuff. So, all right, guys, you take care.
See ya. Thank you.
Thank you.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal.